Let's talk about borrowing money in retirement, not before retirement, but in retirement, because that's what we all are. We're retired. And do we have a need for money in retirement? It's hard to say. It could be for a medical emergency. It could be for your children. It could be for an investment opportunity. Maybe your son and your daughter want to upgrade a house and flip it, and they need some money to do the repairs, and it's an opportunity for you to make money. So where do you go to get the money? Now, before retirement, there are options that you can borrow from your 401k or your IRA. I'd be real cautious about those because built into those are a number of traps. They're called penalties and fees. So I don't want to go to that. The other place I don't want to go is that piece of plastic that I carry around in my pocket. That's a trap. They have outrageous interest rates all the way up to 22%, and that just isn't where you want to go. So let's assume you have an opportunity or an emergency and you need some money for a short term. And where do you go to get it? Well, I told you in another video that one of the things I really want you to do, like Dave Ramsey says, you need to pay off your house. But while you're still working, when you pay off or get close to paying off the house, you need to go to your bank and talk to them about a Heloc loan. That's a HELOC, Home Line of Equity Credit. Is that right? Yeah. Home Equity Line of Credit. And what that is basically if you have a first mortgage, they're taking a second position that says they'll lend you this money. And it's usually set up on a floating rate. That is to say it's prime rate at about with a 2% override. So that would put it today at about 3.5% interest. Now, they don't charge any closing costs. They don't charge any fees. It's just there if you need it. When you actually pay off your mortgage, that then goes into the first position. While I had a mortgage and while I was working, I went to the bank and said, I want this home equity line of credit, and they agreed to it. Of course, I was working, and so they were happy with it. Now, if I had gone and done that when I wasn't working, they'd probably ask for 2 years of tax returns, and they may or may not give it to me. So if you're not retired yet, go do it. It costs you nothing. You don't have to use it. It's there in the case of emergencies. So my number one option, if I'm in retirement, and I was building some houses. I have a equity line of credit against my house for $165,000, and I went and borrowed that to finish the house out. Once the house was finished, I paid the loan back, and I made money on the deal. So it was a good deal. So that's my number one source. My second source would be my brokerage account, my non-qualified account. These are non-IRAs or 401ks or solo 401ks or SEPs. These are non-qualified accounts. It's basically what they call a margin account, and that is that they will lend you money up to 50% of the value of your non-qualified account. Now, there's some areas you want to be careful on because they have the right to enforce that 50% maximum. So if you have $100,000 in there and you want to borrow $50,000, they'll lend it to you. But if the value of your portfolio goes down to $75,000, they're going to ask you to bring that maximum loan down from $50,000 to $37,500. Bring it back down to 50%. Now, if you can't do that, they'll sell your stocks. The other downside of that is, unlike the Heloc loan, you're probably going to pay today about 8%, unless you have over $1 million in that account. But still, that's better than the credit card. Okay? So that's another source of money. My next source would be that a lot of people don't think about is your life insurance. If you have some life insurance, whether it's a policy you created and it's a whole life policy, or quite often your employer had some life insurance on you, and when you retired, they signed it over to you, and you pretty much forgot about it. But it has quite often a cash value. Particularly if you have a whole life, your employer's insurance might be a term insurance and it won't have a cash value. But if you have a whole life or a variable life policy, it has cash value, and you can contact your insurance company and ask them if you can borrow against it. Now, the other option you have is, with many life insurance policies, is borrowing against the death benefit. I have a $500,000 life insurance policy. It has a cash value. But let's say I needed $200,000 and I didn't have the cash value of $200,000. Well, what I could do is borrow against my death benefit. They know when I die, they're going to owe me $500,000. Okay? So I say to them, give me 200 of it up front. And they'll say, okay, but we're going to charge you interest. Negotiate that interest rate with them. But that is a source of money. Now, if you pay it back, your death benefit goes back up to the $500,000. So it's a source of money that isn't your credit card. And it won't have the outrageous rates that your credit card has. So the other thing is that you have a house, and you have assets, and you probably have heirs. You can offer them the opportunity to lend you money in exchange for their future benefit, even to the extent, this went on a lot back, I guess it was probably in the 90s when there was an AIDS epidemic. You would get a death sentence. You would get a death sentence from your doctor that says you have AIDS. You have 6 months to live. And you made a decision that, hey, I want to have those 6 months be the best months of my life. So what you could do back then was basically sell the beneficiary of your life insurance policy. That is to say that John Doe over here sees the doctor's projection that you're going to die in 6 months, and you have a $600,000 life insurance policy. I suspect John would be willing to maybe pay you $500,000 to become the beneficiary of your policy, and you could go live the last 6 of your months of your life in splendor. And a lot of people did that. The problem that arose, though, and I would be careful on this if you're on the lending side, is medicine took a turnaround and they got a vaccine and a pill to stave off AIDS. And some of those people are still alive today, and the guy is sitting with the death benefit and the guy isn't dying. So you got to be careful with that, particularly if you're on the lending side, or you're the lender on that policy. The other thing that has become popular is what is called a reverse mortgage. And that is to say you, again, sign off the beneficiary or for your home, and a bank then figures out, based on what your life expectancy is, how much money they will either give you on a monthly basis or give you in a lump sum. That's a reverse mortgage. I don't like that, unless, of course, you have no heirs and it was just going to go to somebody you don't even know, and you had a financial need. Now, by all means, cash it in and do a reverse mortgage so that you can have a better life. My point is, there are opportunities, there are assets that many of us have that we don't recognize as assets that we can borrow money against, even to the extent that we can benefit from it. Let's assume that my son came to me and says, hey, We have found a house for $150,000 that we can buy, and we think we can do some repairs, about $20,000 worth of repairs on it, and turn around and sell it for $200,000. Well, I want to look at it. I want to do some research on it and see if it is a legitimate opportunity. And if it is, and they say, look, we can get the loan on the house, but we need some money. We need $20,000 for the fix-up and the labor and the materials. And look, well, we think there's going to be a $30,000 profit in there, and we'll give you 15 of it if you'll give us that $20,000 up front, or maybe it's 10 or whatever. What I'm saying is, look to your Heloc loan, look to your brokerage account, look to your life insurance. When you're retired, you're going to find the banks aren't nearly as friendly as they used to be when you're working. They're going to ask for 2 years of tax returns. And if you're not showing any continuing income, it's going to be a little bit difficult. So do that Heloc loan before you retire, and it can reap benefits. And again, I want to emphasize, it costs you nothing. It costs you nothing. If you don't use it, you don't lose it. And then also, remember you have those life insurance policies. Many times they have cash value. In all cases, they have a future death benefit. That is an asset. May not be an asset to you, but it could turn into an asset for someone else, and it could be an opportunity for you to borrow some money. So don't limit yourself. Don't say, whoa, there's no way Martha and I are going to borrow any money in our retirement. You may have to, or you may have the opportunity to. Don't look past those opportunities. Remember, this is the best half of your life. So take advantage of it and enjoy it. Okay, if you got any comments on this, go down into the comment section and share your comments of your pros, your cons, your likes, your dislikes, whatever. And also, in the comments, tell me other things that you'd like me to talk about and that we can share our knowledge. That's what this channel's all about. I was a retired financial advisor. I got those certificates on the wall. That's about all they're worth anymore. But I have some knowledge. I'm anxious to share it, and I need to hear from you. Okay, I'll talk to you again soon.